Alrighty, so I am back. I haven't been AWOL or missing anything. I'm not going broke. I just been busy. The last time that I posted a YouTube video, and this is a new mic, so I don't really know how this sounds. I just need to get a video out here, and I'll tweak this thing later and fix it up. Hopefully the quality does sound good and it's not like too loud. But what the last time I posted a video was like 9 days ago. Trusting the process after making 15K, and that video I think was pretty much summing up me and my 150K accounts. So I did buy 550K accounts, and I was copy trading all of those accounts together, for a total max allocation of 750K. Because you can't go no higher than that with the accounts, especially when you have all five of them. All your slots are full. Um, so I'm gonna just show you guys pretty much what happened. I was supposed to make a video pretty much going over like all the trades that I pretty much took leading up to this point with the 150K accounts, but I tilted on the 6th of August and fucking blew the accounts for no reason. As you can clearly see, like the P&L was consistent. Two trades, two, five, three, one, one, two, four, one trade. Um, and then for some reason on this particular day, I decide to tilt and turned a winning trade into a losing trade, due to the fact that I seen the trade idea form on the 6th. If you've seen that sell, then you know. And I pretty much, I don't even know if you could even say tilted, because I didn't tilt. I just got a bad entry, and that caused me to lose, but the trade was still bearish. Uh, so yeah, I ended up losing 150K accounts. That's cool. I went and copped some 50Ks, and now this is currently where I'm at with the 50K accounts. Again, copy trading all five of them. So I'm literally sitting at above like 10 racks. I just need to make another 1,000. So that's 15K. So yes, once I make 15K in demo profits, yes, this is a evaluation. This is not real money again. I do not hide my P&L. I don't hide anything. Everything here is showcase. This is the real aspect of trading. Sometimes you will lose, and as you can see, you can be profitable. I was on like a 12-day hot streak, and on that, well, 11-day hot streak, and on that 12th day, I tilted and blew the accounts just that quick. It can happen. Even though you could be an amazing trader, you could still lose money on a particular day just by being undisciplined. This is why setting rules for yourself is very, very important. And my rules on that particular day was just something that I did not respect. So I lost. And I lost big. $6,000 worth of profit. That's like over 40 grand blown in a day. It's horrible. So these 50K accounts here are not my first batch of 50K accounts. I actually resetted this. This is the second time of me resetting these 50K accounts. If you look into my chat, give me 1 second. I'm trying to look and see where it's at. I think it's in yeah, it's my progression. So this is pretty much where I post my P&Ls and things of that sort for my accounts. Um, I think it was this day. I have to. I believe I could go back into the billing and find the previous 50K accounts, but this is what the account balance was sitting at before I ended up losing, and then I ended up buying accounts on the same day of me blowing on the 15th. So I was literally sitting around this same progression, around like the 2.2 $2.4 range. Literally just need to make like $700-800 away from passing, and for some reason every time when I get closer to passing, I somehow tilt, quote unquote. But I end up losing on that particular day of it, possibly being my last trading day. So I definitely need to dial back a little bit on the trading and just focus on just being more patient with the waiting, but not only just being more patient with the waiting, but capitalizing once the trade has actually, took place. So I was doing good. One trade, two trades, two trades. On this day, I ain't gonna lie, I was scalping the fuck out of Thursday's PA because it was just panning out so much that I just didn't stop trading. So if it looks like I took a large number of trades, that's because I was scalping positions pretty much short positions all throughout price action due to me missing the first entry of where I could have got in. So I was just scalping, just clean scalps. But yes, ended up losing that batch of accounts, and then I got new 50K ones. So let me scroll past that real quick because I don't need nobody to see my information. I have to go back and find this actually. I don't want to waste too much time on this video trying to piggyback into finding my accounts because I don't know. Okay, show closed accounts. There we go. So I was able to find it, evaluation and view. So you can see that I was literally up, yeah, 2.2K. One good trade away from passing just $800, and I blew and tilted. I lost a number of trades here using way too many contracts, just being greedy. So you can see my P&L here, the trades that I took, how long they last, all of that. So net P&L, that's really what blew me. Made 1,300 that day, and this day I fucking blew. So I'm going to view it, and you can see exactly how many contracts I was using. I wasn't using anything crazy. I just was holding on to too many positions, trying to scout both sides of the marketplace because I seen opportunity, when really all in all I was just trying to make my money back. And as you can see, when you trying to make your money back, that's how you end up losing accounts that are winners. So that's what happened. So I just wanted to make a quick video just showcasing like what happened to the 150K accounts, what I'm doing now with these new batch of accounts. Moral of the story, all it is that I'm saying here is that it doesn't technically matter, you know, how good of a trader you are. Yes, I am a solid trader. I maintain about a 80 to 100% win rate when I do capitalize on trades. A lot of the times, like, I do call out some amazing trades that be panning out for like, excuse me, but I do call out some, you know, amazing trades that really do pan out for like, you know, 400 points to the downside, trading NQ, trading any of the indexes for real. They, for the most part, correlate the same. So the point ranges are going to be somewhat identical when they are in sync. So I do call out some amazing trades. I catch some amazing trades. I make some amazing profit. I'm trading NQ. You know, I'm trading NQ on a 50K account and, you know, making over 10 racks in 4 days. So trading is not a problem necessarily for me. One of the things that I would say will be a problem for majority of traders, and hopefully this impacts someone, is that you go on tilt when you know, you lose a certain amount of money that you weren't looking to lose, but you see the trade and it looks so good, and then you get back in, and then it may be traded into like some PD array where you shouldn't be trying to take a sell at, and it traces against you, and you induce more leverage, causing you to lose even more money. And it's like over time you just blow your account, and you don't even trade a lot, but you blow your account passively by holding on to ideas that are just not ready yet. So I say one of the biggest thing about being a trader is that you have to try to focus on not going on tilt, and sometimes it can be very, very hard. You could be trading perfectly for like 3 months straight, you know, a whole 2 weeks, damn near. That's what I was doing, you know, 11 days of straight profit, no losses. And I took a loss on that particular day that just didn't sit right with me because I knew the trade was going to do what I wanted it to do. I just had to sit through the drawdown. And guess what happened? I blew the accounts. So as a trader, you have to set rules for yourself, and you have to respect those rules no matter what. Limit your trading as much as possible. If you do want to take a certain amount of trades, make sure that those trades that you take are the best trades that you could possibly take of your life. And if you lose, then you're satisfied, win, lose, or draw. You know, even though I called out an amazing trade using 2 contracts and I wasn't able to hold on to that idea because I was coming off of a loser. And one thing about me is I try not to risk a certain degree of points. If I'm trading one contract and I'm trading NQ, I try to keep my losses within a $300 to $400 range, no more than $500. And with fees and things of that sort, it's going to be a little bit higher than that. But I try not to risk no more than 15 to 20 points. 25 is like the max that I do, which is $500. But I try to risk no more than 15 to 25 points per trade. Uh, with a 50K account, that is literally about like 11 to a good maybe 24 or 5% of your account, which, for 50K, that is a lot of risk inducing, 19-20% risk, on your account, though it's, a little 30% away from 50%. Unfortunately, it's either you induce more leverage to pass faster, but you do it with risk set in mind that keeps you, still being able to trade a certain amount of times. The way that I have this set up, and I also, have this information within my Discord. You go in the community, go to tips, risk management. You'll see, this is literally how I trade my accounts, and I post this here for people to copy literally, what I'm doing to fast pass 50K accounts. So if I know that I need to make, $3,000, really it's 5 grand. Uh, Oh no, that's wrong. But yes, the target balance is 3K. I forgot why I put this here. It had to be some importance. I'm guessing it's because you start from 50K, but you really have to make three. But you have $2,000 in the starting balance. I don't remember what it was that I was doing here, but moral of the story, I set exactly, how it is that I trade here for pretty much everyone to see what it is that I'm doing, the pair that I'm trading, and of course the tick slash point percentage. Um, Basically, the formula behind how you even understand how many contracts you're risking per trade, uh, whether it's in points or in ticks. I do the math for you guys. I put the formulas in here. From there, it's just you literally trade your pair. You have to understand exactly what the dollar value is for that pair. And then, of course, what contracts are you going to use that fit in between your risk parameter of like $400, no more than 500 if you trade in a 50K account. And even, with the higher tier accounts, you still copy the same risk parameters where you don't want to risk no more than about like $500 per trade, because with 50K accounts you have you can't lose no more than $2,000, but you only have $2,000 worth of induced leverage. So you don't want to, break that barrier of like losing $500 one, two, three, 4 times, and your account is done. At least with me risking this way, while I'm trading one contract on NQ, but keeping my risk within the parameters of like $300 to $400, I'm still able to trade at least like 6 times before I blow my account. So as a trader, especially this being a high probability game and having such a high win rate, but I don't have a high win rate in the sense of you know, I guess like winning trades, I have a high win rate when it comes to my risk to reward. So I set a risk to reward that I like to see for myself due to what I see on the charts. And, those risk to rewards sometimes be like 1 to 15s, 1 to 20s, 1 to 6s. That's what my win rate is based off of, my hit rate on my risk to reward. That's what matters. Anybody can win a trade and close they trade out in profit. And, I have an 80% win rate. Okay, what is your risk to reward? If you have an 80% win rate, with what risk to reward? Are you 80% of the time winning trades with a 1 to 15, 80% of the time winning trades with a 1 to 3, 80% of the time winning trades with a 1 to 5? Those are the things that I look at and I pay attention to when it comes to my trade win. It's not the win. I'm more so worried about my risk to reward, as in what am I risking and then what am I looking to gain on the opposite side of that trade. So that's how I think about it. So yeah, check out the Discord. It's free. Link will be in the description. So now, this is where the fun happens, because this was a pretty quick day. Uh, Looking at the trade, I was in this. I wish I would have recorded, but I was just doing other things. I was in this trade for no more than about like 7 minutes, the duration of both trades put together. So I broke even. I try to limit myself to 2 trades, and after that, I'm done. So I'll go ahead and just give a nice little breakdown on what happened here for me, what I was looking for, and pretty much what my thought process was with today. So with today, I didn't use any correlation. Usually, I do use correlation with multiple indexes such as SPX, which is ES on future contracts, and of course the Dow, which is YM1, and then I use NQ. But I didn't need any of that today. I pretty much already had an idea of what price was gonna do, and all I had to do was just patiently wait for that idea to form. So let me get rid of some of these annotations because these are really just the ones that matter. So the very first thing that I did was I identified where the high of the day was. True day, I look at the high within Asia because that's literally where the high of the day forms at in Asia. But of course, ICT, he'll say the algorithm kicks in after midnight. That's when price does its thing. But I still like to know where we are on the high of the day, and of course, the low of the day was made down here after midnight. We came down here and traded and made the low of the day, trading underneath Asia session low at 2350, and then we made the low of the current trading day, Wednesday, at 105. The times might be a little bit off depending on what time frame that you drop down to. So I can't necessarily say 105. If I go down to like the 3 minute, it might change, and instead of being 105, it's now 103. So that low, I guess I'll just put it on the minute because I know it'd be accurate. It would happen at 108. So price made the low of the day at 108, and you would call this pretty much a London session low, because all I'm doing, my strat is I'm trading from market range to market range, if that makes sense. But these are the market ranges from previous sessions, such as Asia session high and lows, London session high and lows, and of course New York. You look for it to continue itself into that draw of liquidity that we identified from Asia session high in this sense and London session low. These areas for price are pretty much the high, the low of the day. I really say like you have to notate your session highs and lows because usually those dictate where the market creates PD arrays. The low of the day, some 4 hour key low, some 4 hour key high, the high of the day, and then we gyrate price in between that high and low of the day, and then you focus on where the draw of liquidity is. Are we more than likely to go to the low of the day, or are we more than likely to go to the high of the day? But what is price doing in that range? So really what we do is we start eyeing what market is doing internally before it seeks the external price ranges, trading outside of its current range. So if you understand time and price, you do understand that there are ranges on all time frames. No range is pretty much better than the other. One thing I will say though is certain ranges highlight key things. And I just had a conversation with somebody about this earlier, a student, where he was asking me, how did I feel about, trading off of higher time frames. Keep in mind, price is fractal. That means whatever you see on the lower time frame is the same thing that's being showcased on the higher time frame. Every single candle on the 5 minute, 1 minute, 2 minute, 3 minute, 15 minute, 30 minute, hour, 4 hour is literally going to be showing this same move to the downside, this same bearishness at 9:30. And I'll prove it to you just by popping the chart up. So you see here on the 4 hour, that 4 hour candlestick bearish. You see here on the 1 hour, that 9:30 candlestick that's in the 9 o'clock candle, bearish. The 30 minute, which is the 9:30 that we looking at off of the 5 minute chart, bearish. Every time frame lines up. It's called price fractals. Fractals at price, power 3. That's what you would consider it, where the 30 minute candle is pretty much that's the open, that's the high of the 30 minute candle, and then it spools lower and then it closes and then makes the low of that 30 minute candle. That's the idea that you keep behind it. Yes, that isn't the 30 minute low down here. It's really two 15 minute candles make the 30 minutes, so that means that the low of the 30 minute would be right here. But I'm not trying to get too much off topic. But price is fractal, so it doesn't really necessarily matter what time frame that you look for a I guess like a confluence into like taking a trade idea. It's really just you use the lower time frames to pretty much gain an idea of how you want to get into where you see price going to on the higher time frame. So let's say, like, you're an hour trader, you probably look at the hour chart. Maybe you scalp off the hour, but let's say I'm using the hour chart to get an idea of what price is trying to showcase to me on the hour, but I'm looking at it on the 15-minute chart, but I'm looking at it on the 5-minute chart, so on and so forth. So if I'm reading price on the hour and I'm looking at it on the 4 hour, and I understand that price is showcasing to me that we are bearish, we are in a downtrend. As you're looking at price is literally showing you lower lows. It's trending downwards. So we know that. So if I'm trading with that bias of being a seller, what do I need to see price do in order for me to continuously keep selling? So that's when you start getting into, okay, though I don't do this sometimes because I understand what I'm looking for. You identify midnight opening price. We take the last up close of this bull candle at 0 GMT, and I call it MOP, midnight opening price. And then from there, we look at what's happening above midnight opening price. Because if we are looking to be a seller, we want to see price rally above midnight opening, trade into something, 15-minute fair value gap, from the 30-minute. The 15-minute is just a refinement of the 30-minute fair value gap. And then from there, price breaks itself down above midnight opening. What do we have? A bearish order block being formed right here, and at 9:30. We respect that, and then price shoots down. And that's all happening above midnight opening. So in a way, I say, like, one of the key takeaways from what I'm saying is that we are above midnight opening price. Sorry, when we are above midnight opening price, you want to look for the market to give you the idea of the trade happening, before you get that predetermined draw happening to the downside. We get to see the market buy up, create the buy side of the curve, and we're trying to trade into the buy side of the curve, expecting it to be bearish, which, that's pretty much how candles form. Even though we didn't come up to the high today in Asia, it still created I guess, a notatable trading range where, this is where price just wanted to sit between this high and this low. So, like, you have to have, like, a key understanding of, like, trading ranges to understand, like, why you look at certain ranges and why you don't look at others. But in between this high and the low, and also between the high of Asia and London session low, price decided to gyrate in between this range and decide on the matter of where does it want to go to first. In this case, we were already banking on bearishness. The market has been, predetermined bearish for the past 2 days. Even though Monday was choppy, we still been holding a bear swing. Let me zoom in. Even though the PA was choppy, we still been holding the bear swing. Sunday opening price, we make the high up here. It trades lower and trades lower than the previous open and closes down here. That's bearish. It opens here, rallies up, creates the high, and then trades bearishly the whole damn day. And then Wednesday, same shit. We just getting a continuation of a bearish leg. So that means every single day that you look at on the daily time frame from Monday to Wednesday has been bearish. So you're trading with that draw on the daily time frame that we are going to continue to be bearish. So where could we possibly go to on the daily time frame if we're going to be bearish? And you see that's that old swing low here. And I'm going to make this orange because we're going to notate this level and get an understanding of why price decides to poke into this low and how you could trade with this bias of being a seller and catching the draw on your for your entry, which is pretty nice. So the reason why I have this chart here is just so you can understand the fractalness in price, is that the same swing here that's being showcased on the hour is the same swing here that we are looking at and being broke down on the 5-minute chart. So I'm going to zoom into this because there's things that I want to talk to you guys about with price. The reason why this red zone here is highlighted is because price was sitting at a point of equilibrium between a bigger range. And all I did here was just take the Fibonacci and take it from Asia session high and drag it to London session low. That gave me the equilibrium price point of the range. And let me grab that for y'all real quick. Right there. And then equilibrium. I'm gonna drag it right here. It doesn't have to be dead center accurate, but it's just to give y'all an idea of, how I build the confluences for a lot of these trades. So I identified what the market made its high, and then of course its low, and then from there I'm studying the buy side of the curve. I'm trying to get an idea of what price is trying to showcase to me first before we actually get the sell off. So let me look for my tool real quick because I really want that curve tool. I thought it was in the trend lines, but I guess not. Yeah, there we go, curve. So I'm just studying the buy side of the curve just to see why price is, trending up. And once it does go up, where can I possibly anticipate the flip to happen for the actual, side of the move that I'm looking to participate in. So we got to study the buy side to understand why the market is creating buy side liquidity for sell side inefficiencies. Well, it's creating buy side inefficiencies for sell side liquidity. Hopefully, I said that right. So, studying the buy curve, that's why I have these annotations here, because we see that we turtle souped Asia session low and then created the low of the day here in London at 10, I think 103, I believe, or 108. We create the low of the day here, and then the market rallies. So we leave this range down here. Price leaves this range here that it was gyrating in, and it breaks the price swing. So now price is no longer, doing this here. It's no longer creating this high. That's what I'm notating. And then it goes down and makes the low. And then it makes a lower high. And then it makes a lower high again. And then it makes a low that's lower than that previous low here, which is the rate on stops, turtle soup. And then it rallies and it goes higher, and then it breaks that previous swing high. That right there, that broken price swing, that's why I annotated that, because it's pretty much telling me that we're possibly having a shift in market structure, a change in character. The state of delivery is no longer bearish. We are now bullish intraday, just at this point in time. But this is like, how you would pretty much look at London session and prep yourself to be a London session trader. Possibly what you needed to take a buy within London session, and you needed to see a turtle soup of the market low that happened in Asia. You need to see Asia be swept. And of course, you need to see a break of a key level. That high there was the break of the price swing. That is the focal point. I like to take the focal points of price swings and study those areas, because I consider these focal points of the price swing, this high all the way down to this low, that range that we're dealing with. And if price breaks out of that range, then we're no longer within selling territory. There, you definitely anticipate short-term buying and look to take it higher and mark off those levels and look for these levels to potentially be, targets. If you are the type of person that is a reversal trader, then, utilizing something like that, it would be great for you, because you trade market reversals. Me, I try to focus on, the opposite, the clear-sided draw. Though I could trade reversals, I like catching the actual portion of the move. So I have to wait. And in this case, I had to wait all the way until New York session, because this is where the move showcased itself. So you'll see, like on sell-sided days, depending on how the structure is built up, Asia and London will pretty much tell you a story of what price is trying to do. You see how in Asia, let me find that thing again so I can draw, and I need to mark this. But you see how in Asia, the sell side of the curve is respected, and then for some reason we come here and we stop selling. And then in London, we create the buy side of the curve, and we go from selling to buying. And then in New York session, and we finish out that complete idea of selling just in general. So when you study your market sessions, you start to understand how liquidity is being engineered into the marketplace, and where's the best times of that engineered liquidity to actually form. We get selling opportunity in Asia, buying opportunity in London, and then we get the actual full draw of the move in New York. So this is pretty much why I don't trade Asia. I don't trade London. I just trade New York session because that's where majority of the draw of liquidity does happen. But don't get me wrong. There are, plethora of times where you might be able to catch the trade in Asia and just hold Asia sessions entry and expect that in London, maybe it might be a slight little retracement, but you want to see price continuously keep breaking down. And you already got your short idea in Asia and you're just holding it, expecting that Asia is going to be the high of the day. And then from there, the low of the day will form all the way in New York and trade into a PD array, which is exactly what it does. So I'm not saying that you cannot trade Asia session. I'm not saying that the best opportunity to trade is London either. All I'm saying is I wait for 75%, pretty much my win rate. I wait for a 75% chance of me actually being right on the trade than a 25 to 50% chance of me being wrong, because 75% of the PA is already created in Asia. 25% is there. Then in London, another 25%, that's 50%. And then in New York, that last 25%, that gives me a 75% chance of, okay, depending on what happens here in New York, whether we go high or we go low, I know there is a strong possibility that this trade could possibly hold. That's all it is. That's the reason why I trade New York. That's why I primarily just look at New York, because it's just way easier to trade. All the liquidity and structure, things of that sort, is built for you. So you just have to follow your footnotes. So pretty much what I was seeing here is on the 30-minute, we had a fair value gap, though I did not refine it off of the 30-minute. I did it off of the 15-minute chart. So that's what it looks like on the 30-minute. You could take the fair value gap from there, but I refined it into the 15-minute, and it still respects that fair value gap from the 30-minute with the 15-minute refinement. And we end up doing what? Creating the high of the day technically here. ICT, he teaches you that the high of the day typically forms after midnight, which is exactly what happens here. But we know that the true day high is within Asia, but we never came back to Asia sessions high. So we're going to use the high that was formed after midnight. So this green line here is just me representing what the high of the day is. And dragging a price note, the high of the day here is formed at 23,452 flat. So we form the high of the day there, and then from there price breaks itself down and it never comes back up. So from there, okay, what do I consider to be a break in market structure? Because yes, you understand what a high of the day's form. You want to see price trade away from the high of the day. I like to use the order blocks that be in stronger confluence towards key levels. So we formed the high of the day up here and we create an order block from the high of the day. I want to trade that order block because there's a strong confluence that we might not ever come back up to the high of the day because price has left the order block after trading into a PD array. We didn't trade into a PD array here, but I guess you could consider this previous down close candle high to be like the PD array on the current day because it turtle souped that high, and after it grabbed orders above here, traded to the fair value gap because price was not efficiently traded into in this spot. This is where you could anticipate a reversal to form, which is pretty much what happened. So it was just holding the reversal formation that formed up here, and then it broke itself down. One thing that I like to do when I want to see exactly where breaks in market structure happens, I switch over to a line chart. I'll make the line black, but I like to use line charts, and then I study where the actual candles close, because wicks are not real. Those are not something that you see. That just shows you the last known area that price is traded into. So I'm looking for the break, and that break happens here. So we broke structure here on this last low. The price rallied up, turtle souped the highs, respected that FEG, broke itself down, break a retest. So we get a break and a retest right into what? The order block. So right here, creates a low, breaks that low, retests, and then trades lower. So pretty much what that is this right here. I need to add my drawing tools. So that low, the break of structure happens there. Price taps lower, retests. This high does not get tapped into because remember that's where our order block is. We're looking for that to hold, and then price breaks itself down and breaks structure, and it continues breaking structure and heading lower. And that's pretty much the idea that you want to have behind looking for those types of trades after we break market structure, is just sensing where the break is happening, due to the size that the market has already showed you. Now at this point, you just wait until 9:30. There's no magic to this. Uh, so at 9:30 on the 15-minute chart, that's where I sense the first order block. Again, you cannot see that on the 30-minute chart. But keep in mind, price is fractal. So if there's something that I cannot see on the 30-minute, that means you're going to do what? Scale down. So I jump from the 30-minute to see the 15-minute because these wicks here, I want to see what this price is showcasing to me. So I have to drop down until the price becomes clear. Now those wicks on the 30-minute chart can now be seen on the 15-minute. So I notate off the breakup market structure. That's what I'm able to identify using the line chart. I can see exactly where the true breaks happen. Cool. Then price consolidates, trades all the way back into the order block and rejecting it strongly. Just playing in the order block over and over and over and over again until 9:30. Consequent encroachment. So it trades it to the order block, trades a consequent encroachment. 50% of the order block respects it. And then at 9:30, we get another opening. Probably some raid on stops right here. If you could break down lower time frames. I don't know exactly if it rated some stops, but the wicks on the 15-minute look exaggerated here and here, where it looks like it was going high, higher, high, higher, high, like a 3-candle drive, and then dropped at 9:30. But on the 15-minute, it might be a little different. This might be that high, and then that other high again, those 3 highs, and then it rated it here. So it just looks a little different. I'm not trying to be like pinpoint precise with it, but this right here is the high on the 15-minute. Right here is that high, and then all these candles right here from this high, that high is these 3 highs here that's being represented. So all I would say is just notate off the highs off of here and just go drop down to like the 5-minute chart, 3-minute chart, and study those highs that were sitting around at 9:30. Try to get a feeling of why price, possibly came back up here. Because if you could see, the failure swing to get back above here within the fair value gap on the 15-minute, that means when you drop down to the 5-minute, it's the same shit. When you drop down to the 3-minute, it's the same lower highs. So that's what I mean by price is fractal. And now, you get deeper into it. And now you can see deeper into the order block, finding the trade within. And now we get an order block, a refinement of the 15-minute order block, or a 3-minute order block that is hiding amongst us that we cannot see. So 3-minute order block. And then at 9:30, we trade right up into that order block, creating failure swing highs, and you sell short within the OB, or you sell short within the 15-minute one, or you wait for other confirmed breaks. You wait for the breaking market structure level to be tested. You sell short there. There's so many possibilities where you could sell short at. It gave you plethoras of opportunities to sell short within, before the trade idea formed, at 3-minute order block and respecting it, creating lower highs. You could have sold short at the break of market structure. You could have sold short here, here, here. All of these areas, the break and the retest, like all of these areas would give you possible opportunities to catch this move here into the downside. So, looking at where I got in, let me go back. Charts and data. Show chart execution, save. So you can see I literally got in at 9:30, and I caught the trade. Don't get me wrong, I did catch the trade. But what happened was on the first trade, I got in a little bit too early. So I got in a little bit too early. What first entry was here? I was in it, and it was 370, 370, 370, 370, 370. So I got in right down here because I needed to wait and see like if it was gonna truly break. So I wait for that displacement. Pretty much where I got cut short at is that the displacement happened, and I really should have got in up here at 9:30 immediately, but I waited, and then the pretty much the 5 candlestick closure of the 930. It closed down here, created a bottom, and then it retraced against me. Mind you, I'm trading 50K accounts, so my stops are pretty tight, but the moves that I look for, even though I have tight stops, they still pan out. It was just an incorrection due to me. I waited too long to take the trade. So I got out and I got stopped out, and then I literally sold short again up here with 2 contracts at 23,376.25. And I should have held it because the move was still like, it was still in the beginning stages of the sell. But I don't like taking a loss and then having to recuperate the loss and then make money on top of that. And I'll say the reason why I do that is because, wow, man, look how far this shit dropped, and my entry was here in this candle. So imagine if I was able to hold this trade at, what, 376 right here, all the way down. This shit fell for fucking 340 points, and this is not even the accurate price levels. But just doing like a rough estimate of how much that is, 340 points times $40 per point, because I'm using 2 contracts. Bro, this was literally a $13,000 move to the downside. And I have 550K accounts. Times in that by 5. That is literally $68,000 that I could have made if I was funded. But unfortunately, I'm in eval, so I can't even make that much money in the eval. But imagine, the people that ate off of this move to the downside just using 1 contract on NQ, 2 contracts, $20 to $40 per point, and just eating. So it's amazing to be able to see these moves and catch these moves, and like I'm literally catching like 1 to 15, 1 to 20 RR positions. 176. I'm gonna just take 176 flat because the 0.25 is like the tick. So 176 is like right around here. Yeah. Can I get 176 on the? See, I'm gonna do this. I don't know why I'm playing around with this. And I said 176. I meant 376. 376.25. That was entry. Again, 15-point stop. Like, I had no reason to close out this trade. It was literally nowhere near my stop, like, at all. 15 points. That's what I like to risk. 15 to 20 points. Boom. And if I would have held it all the way down to the PD array, that would have been a 1 to 20 RR. Every dollar put at risk, I'm making 20. Great fucking day today. So I can't even be mad. This was an amazing trade. For me to be able to see this with my eyes and catch these types of opportunities, even if I do break even or I don't make anything, it's still amazing. And after we traded to the PD array, the previous, day low, from, some previous market section, that daily level, price reacts off that level. And, for my reversal traders or people that like to trade retracements, you like to see PD arrays get traded into because you expect that the market is going to reverse, break structure, give you some type of entry model into a long. Though I don't trade reversals, sometimes I can make money off of them. I just have a very low hit rate with trading reversals. But trades it to that, break structure, gives you the entry model, and you take your long here. 15 points. 15 to 20 points is within your risk parameters of $300 to $400, and then you target this high, 106 points. It comes up again to this second high up here, 145 points. Turtle soups it, and then this third high up here, the price could levitate up to within the last final hour, but who knows? It might not get up into there, but that's pretty much how you would trade reversals. So, man, this was a long video and a lot of talking. Hopefully you learned something from me. Though I might be a good trader, there might be some times where I do fuck up, and that's okay. That's the beauty of trading. You're not going to be perfect. So I hope you guys enjoyed the video. That was pretty much the trade for Wednesday. The things that I guess I've been doing with my progression. I've been gone for a little minute, but I haven't been gone due to me just like not making money or anything. Like it's never about that. It's just I do still work a job. I still do things with my life that I like to do. Or sometimes I might not just have enough time to make no YouTube video. But that's pretty much like recapping what happened for the day. That's what I seen. Uh, Hopefully you understand, you know, how this same fractal on the hours, this same fractal that's being showcased to us on the 5 minute, the 15 minute, the 3 minute, you pretty much just trading with the bias of trying to keep your trades in sync. So you want to see the higher time frame show you that it's bearish, so that when you get in on the lower time frame, you trust that bearishness that's being showcased on the higher. So if I'm on the 15-minute chart, on the 5-minute chart, trading the 930 candlestick on the 15-minute chart, and I go to the 30-minute and I see it's bearish, then of course that means that it's also bearish on the 5-minute, the 15-minute, the 1-minute, the 3-minute. Every time frame is going to show bearishness, and you trade with that bearishness with your entry model, and you execute the trade with the risk that you have set for yourself. So thank you, and you guys have a good day.